I'm just going to give you an overview of what's happened in global equity markets so far this year, some of the changes we've made in our portfolios, and also an update of what we think might happen to global equity markets going forward. It's been a very interesting year so far, big discrepancies between different markets, the long-established trend of US equity markets and the technology-heavy NASDAQ market in particular continuing to perform better than other areas of the market is still well entrenched. When you look at Europe and emerging markets in particular, those markets are quite weak. A market like China is down over 20% year to date in US dollar terms, whereas the NASDAQ is showing double-digit gains year to date. Furthermore, when we look at the components of what is driving those returns in markets, it continued to be the technology companies like Amazon, Microsoft, MasterCard, as well as other semiconductor companies like NVIDIA, continuing to perform very well along with Netflix. As investors, we have had exposure to names like Microsoft and MasterCard. That's worked out very well again this year, but we are very aware that valuations are quite stretched for those companies, and we have reduced some of our position sizes in those names. On the flip side, we are always looking out for value in the markets. We think that in some cases emerging markets have overreacted to some of the bad political news, the most important being the trade war speeches from the President of America, Donald Trump, and that is clearly having an impact on emerging markets at a time when some markets like Turkey and Brazil was already suffering from some imbalances and caused a lot of weakness in those markets. As global equity investors, we are not exposed to some of the core issues in markets like Turkey and Brazil, but clearly there is an indirect impact on some of our positions, including some of our consumer staples names, but we continue to focus on those areas with secular growth dynamics which continue to be unaffected by some of the geopolitical storms, and we continue to avoid, for instance, financials who are operating directly in emerging markets. We also feel that once the political environment has died down and President Trump actually calms down a little bit in terms of what he's saying and some of the noise he creates, there will be some interesting valuations from where to start building positions again. So with that in mind, we have looked at some of the names we owned last year and which we sold, including names like Baidu and Alibaba. Those valuations, along with names like Tencent, have pulled back to levels where we're starting to increase our exposure again. In the case of Tencent, we've upped that position to 3% from a 2% position early in the year. We also feel that the secular growth dynamics in emerging markets with regards to discretionary spending, adoption of cloud technology, as well as a general uplift in disposable income will continue for the long term, and therefore we're looking at companies that can benefit from that in the very long term. Now, at the moment, our cash positions have dwindled down. We have found some interesting new names, including Samsung early in the year, as well as names like Allergen, which is in the pharmaceutical space, as well as names like Sabre Technologies, which focuses on software, travel-related industries. We feel that these businesses have long secular tailwinds of growth ahead of them, and by March, April this year, on the back of what Donald Trump was saying about drug pricing, those names became very interesting and traded at very low price-earnings multiples where long-term investors could take a position. On the flip side, though, we have also sold out of names that have worked out very well for us over the last 3 to 4 years, including names like Moody's Corporation. They operate in a very competitive industry of credit agency-related industry, but we also feel that a couple of years ago they were unduly punished with valuations reaching very low levels. From here, though, the company is going to struggle to get more expensive. So when something gets to 23 or 24 times earnings, we typically sell even if it is a great business. And we feel as value investors we will continue to frame our positions and also our philosophy around that of a growth at the right price philosophy. With that in mind, given that the US market is quite long in the tooth, we believe it's the right thing to continue to rotate away from overvalued businesses and into more emerging market, perhaps a little bit more cyclical businesses where we see more value, even though the risk is perhaps a little bit higher in terms of forecast risk for those businesses. Looking forward at returns, this year markets are up 5% in US dollar terms year to date. We are about 2% behind the benchmark. We feel that given the very lopsided effect in the market where a lot of the returns, up to 50% to 60% of the returns, are driven by a very small part of the market being US technology stocks, it's right to step away from areas like that where perhaps the Amazons of the world and the Netflixes of the world won't continue to perform as well as they have, given the very, very stretched valuations, and that a better value-based approach at this stage is more, perhaps a better way to get returns in the market going forward. We still believe we won't see the 13 to 14% compound US dollar returns that we've had for our investors over the last 5 years. I think it's more a 6 to 8% return environment, but that all depends on how volatile the markets will be going forward and whether the geopolitical news in the future will create opportunities for us to spend some of the cash that has been building up over the last year from about 12% to 14%. With that in mind, we continue to be bullish on the secular growth areas we've identified, whether that's electronic payments, consumer discretionary spending, as well as other cloud-based subscription models. And for that matter, we are not going to sell out of Oracle, Microsoft and Sabre Technologies anytime soon as we harvest some of those secular growth winds going forward.